Hello and welcome. I'm here to bring some perspective for you today because when people don't have perspective, they make bad decisions. And there's a saying that people who don't study history are doomed, and the people who have come out on top are people who bought real estate no matter what the market was doing. That is a fact. So let's break it down and look at the 6 factors that drive the US real estate market, and that will give us an idea of where we are today and where we're headed for the long term, because it does tend to contradict what the CNNs and NBCs and the Foxes of the news are saying. Their job is to make you watch the news, not to give you perspective. So let's dive in. Let's first look at the home volume. Now this is the national data point, and what's interesting is that it's not getting progressively better. People are expecting it to get progressively better, but that's not how history has worked out in the past. And if you look at history, it usually takes us 3 to 4 years to get out of a trough like this. And my guess is that it's going to take us another year or two until we do, so we'll be in the market that we have today for probably that duration of time. And if it's better, then woohoo! Now what's interesting is where we are today, it's not the lowest we've been. Even that $4.1 million number back in 2008 is a rounded number, and the lowest on record is actually back in '95. That is 29 years ago. 29. Even when we had the Great Recession in 2008, the financial crisis, we didn't hit zero. And that's because real estate will always be happening because life happens. People get born, they have babies, they get married, they pass away. That's just life. One more time, sorry. This is why the Fed policy, the government hasn't speeded to change things, because you hear all of this talk about recession. Well, the data shows that we're not in one. Only the US national real estate market is in an economic recession, and there's just one industry. So the second number that drives US real estate is home prices. Well, there's this thing called the 4% trend line, and it's the rate of appreciation of real estate over time. It's not exactly science, but it's also not made up. And the reason for that 4% is that it's this confluence of inflation, GDP, cost of goods sold in the economy, wage growth, wage decline, unemployment, and all of that. And if you look at the cost of goods, everything that it takes to create a home, to build a home, and everything that goes into the home is getting more and more expensive over time. That's just inflation 101. And right now we've had tremendous price pressure on the building materials, which is not expected to ease anytime soon, based on the smartest people who are looking at the economic numbers. So we know that the cost of things goes up over. And where we are today is we are 9.9% above this trend line. That's not bad, actually. People walk around saying homes are so expensive, and they are expensive and they're not expensive. The shock that came after the pandemic, we all know prices improved substantially. So think of it this way. If you have no appreciation for 2.5 years, the pandemic years, looking at the trend line, it never happens. Except, let's look at this slide here, home prices. Except it goes backwards in the Great Recession of the financial crisis in 2008. So what does that mean? It means at a national level, homes are trending toward affordability today. Between the mortgage rates and the actual home prices, we're getting into a place where people can buy them. So here's the thing that particularly if you're a real estate investor, you've been following real estate for a long, long time, and that is, it goes up. Prices go up. And no matter how much it goes down, it always comes back up. And now's the time. Look at where we are from a big picture perspective. Now is the time investors are buying homes. Now is the time for existing homeowners to buy that bigger, more expensive property, bigger, better house. When you're in your 20s and 30s, you haven't lived maybe long enough and haven't seen trends like this. And these words might not sound, might not ring true. But for someone who's 70 years old today, that's abundantly true. Home prices go up. And I'll prove it to you. I'll challenge anybody watching this, say yes or yes to yourself if you wish you bought every home in your neighborhood 15 years ago. And think back. This has been true time over time. For 2025, we could see some really strong appreciation for home values across the US if nothing else happened except interest rates came down. Almost always, home prices drop when something bad happens, whether it be man-made or natural. Odds of going to zero appreciation, well, it just doesn't happen. Prices are very, very sticky. Looking at the volume of real estate transactions in US, we are gradually climbing up, just like the number of home sales. And last year we did almost $2.2 trillion, and anticipating for that to gradually start going up, like we talked about in the next, it's probably going to take another year or two to get out of the trough that we are in today. Same goes for inventory. It's a slow climb, but it is a climb, and inventory is gradually increasing. Now here in Bay Area, we have a chronic undersupply of housing inventory. That is generally the case for US as a whole, but Bay Area has been really, really suffering from that chronic condition for a really, really long time. And by definition, when we have low supply and we have higher demand from the buyers, and there is more demand from buyers than there are home sales available, by definition that puts upward pressure on home prices over the long term. Mortgage rate is the next factor that drives the US real estate market, and they dropped to about 6.9% right now. We've been in the high 7% in early this year, end of 2024. And what people don't realize is that 6.5% interest rate, that is normal for a well-functioning US economy. Normal. So I like this chart a lot. And what this says is that 74% of mortgages in US have an interest rate of 5% or less. And 22% of homeowners have less than a 3% interest rate. And 34% have something between 3 and 4% interest rate. And 10% of homeowners are somewhere between 4 and 5% interest rate. And then you have 26% of households that are above that 5% interest rate. And that's growing. And here's the interesting thing. Every year, every time we kind of talk about this number is going to grow. We'll have a lot more people with loans above 5% and fewer people that are below that mark. Until you look at, and now it's normalized. Now it's around that 5-6% mark. And like I said, looking at history, that 6%, 6.5% interest rate is average for a US economy. It is expected that rates will trickle down a little bit, but we're likely not going to be in the 4 and 3% range ever again, essentially, per the leading industry experts. What's worth pointing out is that 38% of all homeowners are mortgage-free. They're not locked into any kind of a low interest rate that's preventing them to get moved. They're mortgage-free. And if we look at it, then 70% of all homeowners, per the data, have an equity stake in their house of 50% or more, which means that 70% of all homeowners own more than half of their home value worth, in a sense. Let's look at affordability. And the percentage you see here is the percentage of someone's earnings, pre-tax earnings, that goes towards housing, principal and interest. That's the calculation used in US. And people might look at it and say, oh my God, 32%. Not worried at all. You should still buy. This is a very interesting time in history. And people started to over-index on experiences instead of asset wealth. And there's a whole generation, that's the 20 and 30-year-olds, that's particularly fixated on that. And that's a generation that grew up watching the financial crisis of 2008, and they might not necessarily have as much optimism about real estate as maybe, because they maybe saw their parents go through a foreclosure or short sale. Statistically, at a national level, people early on in their adult lives live way beyond their means and don't make the necessary sacrifices to build true asset wealth that carries them through the ups and downs of what life will throw at them and bail them out when needed. And as of today, the average first-time buyer is 38 years old in US. It's the oldest we've ever seen. Back in '82, that was 29 years. A few years ago, 5 years ago, 4 years ago, it was 34, 35, 36 years old. And the question for the younger generation is, do you want to be housebroken now or later? It'll be one or the other. If someone buys young, then they sacrifice and they endure that early on in their life, and then they're set for the rest of their life. Okay, so some of these younger generation may look to their parents, which are the baby boomers, who have statistically 50% of the US wealth. And in that case, those youngsters might be set. They're good to go. It could be a calculation in their head. I think the average is $450,000 in average net asset worth for a baby boomer in US. But affordability, we gotta take a look at it and focus on the true asset wealth of your family, something tangible. So there you have the 6 factors that drive the US real estate market at a high level. And the key takeaway here is, don't wait to buy real estate at the right time. Buy real estate and give it time. I'll say that again. Don't wait for the right time to buy real estate, but buy real estate and then give it time. Let's look at this real quick. So, where's all the money? There are 22.8 million millionaires in the world, high net worth individuals. They're defined statistically as somebody with 1 million or more in wealth, and that excludes the home equity type of wealth. And out of those, 7.8 million of them are in North America. That is a lot of people with money, and the question is, where is all of that money going? So let's look at this allocation of financial investments. And all you have to do here is look at the very, very bottom at 2024 to see that real estate is a percentage of where all of that wealth is, how it's held. Real estate is right there at the top, and it's pretty much tied with the fixed income, and very insightful. What's also interesting is that the real estate, as a proportion of how that wealth is held, has been growing, and people have been taking money out of cash deposits, out of the stock market, and putting it into real estate and fixed income. So again, real estate is well represented here at almost 19% of how the high net worth individuals worldwide hold their wealth. I hope this helps put you things into perspective, and I'm always here to help you create a better life through real estate. Thank you so much for watching, and see you next time.